Hi, and welcome to the Day Trading for Beginners podcast. This is season 2, episode 5. And in this episode, we're talking win rates and risk to reward ratio. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader. And in this season, we are studying a strategy. And the strategy that I'm studying as kind of mentioned, win rates and risk to reward ratio. So what I want to do in this podcast episode is just break down these numbers and these sort of formulas into really easy to understand concepts, because I do feel that no matter what strategy you are going to end up studying, it's important to understand your win rates and your risk to reward ratio. So this is not something that you're going to be able to understand and know perfectly right from the beginning, but it's something that you'll need to understand, calculate, and then over time, you're going to really hone in on these rates and these reward ratios. So in the show notes below this video, you can find links to the 6-month blueprint. If you're just starting out with this podcast, I would recommend that you go ahead and download that blueprint if you're a pure beginner. But if you've been following along and you're sort of up to date in the podcast, in the show notes, I have a link to TradingView. So that's the software that I use to do trades. And now we're talking, win rates and, calculating your risk to reward ratios and things like that. And this is where eventually you're going to want to journal some of your trades. So personally, I'm going to be using a service called Trader Sync to journal all my trades. You can use various other tools. And in one podcast episode, perhaps I'm going to talk more about journaling. But if you want to use the same journaling software that I use, you can find a link to that in the show notes. It's called Trader Sync. So let's jump right into it and talk about these win rates and these different ratios. So if you're a beginner, at this stage, you probably understand that success in day trading is not just about, making trades. You need to make, smart trades. One theme that I seem to come across all the time is this idea of preserving your capital. Risk management is really important. And if you don't, risk management kind of just sounds like a broad topic. It's basically, you really need to preserve your capital. You need to not lose money. And for, risk management, sometimes that just means starting out with really, really small trades and then understanding your win rates and some of the things that we're going to talk about today. So, whether you're experienced or you're just beginners just a beginner like me, understanding the numbers behind your trades is going to be, I think, very key to being successful and continuing to make profits. And that's just not just my opinion. Certainly, a lot of the information I've come across kind of says that as well. So if you can imagine, trading with full confidence, knowing exactly how much you stand to gain or lose before each move, that's kind of what these ratios and these win rates can maybe offer you and your strategy. So what we're going to do here is try and just simplify these win rates, upside rewards, and downside risks, and show you how to calculate them and use these metrics to sharpen your strategy, whatever that may be. So again, the numbers that we're going to talk about in this podcast, they might change, but it's basically just for example purposes. You will definitely want to go out and study your own win rate and go over some examples. And again, when you actually paper trade with your own strategy, your exact numbers and percentages might be a little bit different. So again, the figures that we're going to talk about here are basically for just understanding what these numbers actually are. So your win rate, people have said it's really your winning ticket to day trading. And basically, your win rate, it's like your success scorecard. So it tells you the percentage of trades you win out of the total trades that you make. So your win rate is the number of winning trades divided by your total trades expressed as a percentage. So if you make 100 trades and you win 60 of them, your win rate is 60%. So that's kind of an easy, percentage to sort of calculate. So why it matters? Well, your win rate, it helps you understand how often your strategy leads to successful trades. So a higher win rate means that you're winning more trades. It's going to improve your profits. And it's important to know your win rate because there are certain benchmarks. And then when you combine your win rate with your risks and your profit factor, it can be important to maintain a win rate in order to be profitable in the long term. So a benchmark that I've come across is a win rate of about 75%. So this means that, you make 100 trades maybe in a month or some time period, 75 of them should be profitable. Again, that might be a month or 2 months or whatnot. So that is sort of a benchmark that I've come across. And again, your strategy might require a higher win rate, or maybe, you can get away with a lower one, but that's what the win rate is. So you take 100 trades, 80 of them are winners, you've got an 80% win rate. And that's probably a good win rate, and means your strategy is working. Now, there is something else called a profit factor, and the profit factor reveals the strength of your trade. So your win rate is going to measure how often you win. And this thing called a profit factor, it measures how much you win relative to how much you lose. So the definition of a profit factor is, the total gains from winning trades divided by the total losses from losing trades. So example, if your gains on a particular day or month are, let's say, just 2,000, and your total losses on that same time frame are 1,000, that means your profit factor is 2. 2,000 divided by 1,000, your profit factor is 2. And why this matters is that, a profit factor over 2 is considered a strong indicator of a profitable trading strategy, meaning that for every dollar that you lose, you're making at least $2. So this shows that not only are you winning often, but your wins are big enough to cover any losses. So the profit factor of 2, that's a number that I came across. And again, doesn't mean that everyone uses that number. Your strategy might use a different one, but that is what a profit factor is. So, generally you want to aim for a profit factor of above 2, and that's sort of a benchmark. So again, your winnings divided by your losses. That's how you calculate that. Now, you also want to understand, your upside rewards going into a trade, and then your downside risks to help you kind of stay in the game. So once you know your win rate and your profit factor, the next step is understanding your potential rewards. So we'll call that upside, and then your risks, we'll call that downside. And you can try to calculate that in each trade. So here's how you might do it. And again, this is just an example of the math behind it. To evaluate any trade, you can set the following calculation. So you can choose an entry price. So that's going to be the price at which you enter a trade. You can choose a target price. That could be the price where you plan to take profits. And then you can choose a stop loss. So the price where you'll exit the trade if it goes against you to limit your losses. So the formulas here, you've got a reward and a risk. So your reward is going to be, your target price minus what you entered in, minus your entry price if you're long. And then the risk is going to be your entry price minus your stop loss. So your reward to risk ratio, this is going to compare your potential rewards if the trade goes your way versus the risks that you are taking on. So, as an example, just to keep the math very easy, let's say your entry price into a stock is $100 and your target price is 110, and then your stop loss is at 95. So your reward here is going to be 110 minus 100. So you've got a $10 reward, and then your risk for this trade is going to be your entry at 100, take away the stop loss at 95, is going to be $5. So your reward to risk ratio is, you've got $10, which is your reward, and your risk is $5. So that ratio is 2 to 1. It's 10 divided by 5. So a 2 to 1 ratio means that you're risking $1 for the chance to gain 2, which is considered, a pretty, solid setup in trading. So that's your reward to risk ratio. So there are some benchmarks for traders. And again, all of this might be a little bit different no matter what strategy you end up using, but it's just important to know that these these ratios exist and traders follow them. So, day traders, the numbers that I found, is sort of often aimed for, a minimum of 2-to-1 or 3-to-1. So you want to be able to, gain $2 when you're risking $1 or gain $3 when you're risking $1. And this ensures that, even if you lose, trades over time, the winning trades are large enough to cover the losses, because you're not going to win every trade. You're going to make losses, but you want to have your reward to risk ratios in a place where when you win, you're going to be able to cover, the losses that you make. So, including, your win rate and your ratio. So the balance between your win rate and your reward to risk ratio matters as well. So if you've got a high win rate in the strategy that you're using, say 75%, that might allow you to take trades with a lower reward to risk ratio. So if you're winning 75% of the time, you might not have to, risk a lot on your trades. However, if your strategy is just giving you a 50% win rate, so you're, every trade you put on, you win, but every other one you're losing, then you're going to need potentially a higher risk reward to risk ratio to kind of stay profitable. So that's sort of how, all of these ratios and win rates sort of all come together. Now, can you do this in your head and just make these calculations on the fly? Well, you can, but it's going to take time. It's going to take practice. But just knowing, your entry, your target, and your stop loss before you make a trade can help you sort of quickly understand what your reward risk ratios are. And this is going to allow you to make fast decisions without overthinking. And, this is why it's so important to start with paper trading and then practice actually doing these, calculating your risk to reward ratios, understanding, over the month you've got a 60% win rate. How does that factor into what you want to do on this next trade, and so on? And this is why, it's really important that you start paper trading, start journaling your trades, because you can practice doing all of this without risking any real money. So when you put it all together, becoming successful at this, you're going to need a solid understanding of what your win rate is for your strategy, what your profit factor is, and what your reward to risk ratio is. So if this is the first time that you're listening to this kind of stuff and it seems like it's going over your head, don't worry. When you actually start putting on trades and looking at these figures in your journaling, you're going to get a better understanding, and then it's certainly going to be second nature moving forward eventually. So again, your win rate, it tells you how often your strategy works. Your profit factor, that measures the profitability of your wins relative to your losses. And then your reward to risk ratio, that ensures that your potential rewards are greater than your risks on a particular trade that you might be taking. And then some keys to success. And again, these figures might change, but if you're aiming for a win rate above 75%, that seems to be a good benchmark. If your profit factor should be about 2, so you want to be, every $1 you lose, you should be gaining 2 in your trades over time. And then you want to look for a reward to risk ratio of at least 2-to-1. So on every trade, you want to have a target where you're going to gain $2 and risk 1. So those seem to be some benchmarks, and they certainly will change. But what you will want to do, what I plan to do, is eventually learn the strategy, paper trade for several months, and then look at this and say, hey, for the last 3 months, my win rate is 75%, my profit factor is around 2, and then most of my trades are in this reward to risk ratio of 2. I am comfortable now after seeing these successful figures over the past 3 months or 6 months paper trading. Then I can go and make some real trades with some real money. So that's what I plan to do. And then tracking all of this in a trading journal is going to be very important to do. And it makes it much, much easier to sort of track all that sort of stuff. Now, the other thing I wanted to touch on to wrap this podcast up is this whole idea of probabilities in your reward to risk ratios. So this is something that you're not going to be able to figure out right now as a beginner, but I want to talk about it because it's something that over time you can look to be able to, master and be able to do. And I think any successful trader can do some of the stuff that we're going to talk about with probabilities here. At first, it might feel like it's going to go way over your head, but eventually I think we're all going to get to a place where we can calculate this stuff. So, factoring in probabilities into your reward to risk ratio, what this involves is estimating the likelihood that your trade will reach its target or hit its stop loss. So obviously you're not going to know this for sure, but you might be able to give it a gauge based on your past experiences. So for estimating probabilities, probabilities, they are essentially an educated guess based on your past trading experience, your analysis, or the historical performance of like a similar setup that you might be taking. So the probability of success, so that's going to be the likelihood that the trade is going to hit your target price. And then the probability of failure is the likelihood that the trade will hit your stop loss. So as an easy example, if a particular trade setup has hit its target maybe 60% of the time in the past, then you would assign a 60% probability of success and then a 40% probability of failure. So you can calculate an expected value if you have, these probabilities in place. So you can calculate this, and that's going to help you factor in the probabilities to assess whether the trade is going to be worth taking. So the formula for expected value, it's just going to be the probability of success times your reward minus the probability of failure times your risk. So easy example here, like we had before, we had that reward of $10. So going up from $100 to $110. And then we had the risks because we set up a stop loss at $95. So $100 to $95, you got a $5 risk there. And then if we looked at that setup and based on our past history, our trading experience and whatnot, and we said, this has probably got a 60% chance of success and a 40% chance of failure, then we can calculate the expected value. We can go 60% times the $10 reward minus 40% times the $5 risk. That's going to be 6 minus 2, and that's going to be $4. So this expected value of 4 means that on average, you can expect to gain $4 for every trade that you take with this specific setup. Now, a positive expected value, that indicates that the trade has a favorable outcome over the long run, factoring, the risk and the reward and the probabilities of success. Now, you can use these probabilities to sort of filter trades. So if you have, a low probability of success, but a high reward to risk ratio, then you might, still want to consider taking the trade because the reward outweighs the risk. And then on the other flip side, if the probability of success is really low, but the reward to risk ratio isn't compelling, you might choose to skip the trade. So it's got a low probability and the reward to risk ratio isn't really good. You would want to avoid that. So again, you're not going to be able to calculate these probabilities when you're just starting out, you're brand new and you're a beginner just like me. But I think this is something that you will want to look towards learning and being able to do as you progress as a successful trader. So, how would you estimate these probabilities? Well, experience, over time, you track your trades in your journal, you develop sort of a sense of how often some setups might work. So, a particular chart pattern that you see might result in, success, 70% of the time. And then other chart patterns kind of work 50% of the time. And again, with experience, with a lot of trades under your belt, you're going to basically have a better judgment on the probability, and it's going to help you take on a trade or not. You can also do it with back testing. So I'm currently using TradingView, and the subscription I have allows you to do a replay mode where you can sort of test your strategy out and kind of go through some historical data. People have different opinions on that, but you can kind of use that to analyze how often a certain strategy would have worked in the past, and you can do some calculations from that. And then, market conditions. So you can factor in the current market environment, which can affect the likelihood of success as well. So, for example, a trade setup might have a higher probability of success if, you're in a bull market, for example, and so on. So, estimating probabilities, not something you're going to do as a beginner, but something I wanted to talk about because it's something that successful traders do, and it's something that we need to work towards doing. So just to wrap up here, as a quick conclusion of this podcast episode, keeping the focus on us beginners, understanding these concepts, win rates, upside rewards, downside risks. Again, it's going to be key to becoming a successful day trader, but don't be discouraged or think that this has gone way over your head. You can revisit this, and over time, you're going to understand these ratios, these rates, and be able to calculate probabilities as you progress as a trader. So at first, again, it might feel challenging to sort of grasp how these elements work together. And you're not expected to be able to calculate probabilities of your trades right away. I certainly can't do that at all right now. However, when we continue to practice, gain experience, you are going to be able to see patterns in your trades that will help you sort of estimate probabilities. I think that's going to be important no matter what sort of strategy you actually end up following. So again, your win rate gives you insight into how often your strategy works. That is important, and you can calculate that using a trading journal, while understanding that your reward to risk ratio ensures that your potential rewards are greater than your risk. So over time, you're going to learn to balance these factors and incorporate probabilities into your trading decisions with greater confidence. So remember, day trading, it is a journey. It's not something you're going to master very, very quickly. And each trade brings, valuable experience. So with patience, persistence, you're going to refine your strategy, improve your ability, manage your risks, maximize your rewards, and so on. And you're going to build more consistency over time. So I hope that you found this podcast episode useful. In the next episodes, we're going to dive deeper into more of the specifics of the strategy that I am trading, or that I'm learning to trade first. And again, in the show notes, you can find links to the strategy that I'm using, the tools that I'm currently using as well. And then if you have not joined our community on School and you need an accountability partner, certainly jump over and join up and say hello. We'd love to welcome you in over on our platform on School. So you can find all the links to that below this in the show notes. I want to thank you very much for tuning in to this episode, and I look forward to talking with you in the next one.